Welcome traders to this video on the ZoneTraderPro zones themselves and the patterns that they form. Basically in this video we're going to look at the 4 ZoneTraderPro zones, and we're going to look at the 7 types of trades and patterns that develop from these zones. These zones are going to become extremely important because as you move from zone to zone, that is what creates a pattern. So as we see here, the resistance starts off at minor. This is a very difficult to see small little area right here, and that's going to be changed in the next version. We have intermediate. The next resistance zone is called counter trend, and the resistance zone on top is called strong trend. As far as support goes, the same way, we name them minor, intermediate, counter trend, and strong trend. The first 2 patterns are the most simplest patterns, and those are the counter trend and trend trade patterns. In a counter trend pattern, all we are doing is we are trading to the counter trend zone itself, here, here, and here, and then looking for an order flow pattern. In a trend trade, what we are going to want to see is that we first trade to a counter trend zone here, and then we retrace back to intermediate. One important note is that in the original e-signal version, there's going to be several patterns that I'm going to reference today that are not included as a pattern if you turn on the pattern matching software of ZoneTraderPro. And those are the counter trend, the strong trend, and the strong trend reversal trades. These trades were not included in the NinjaTrader version because the risk reward in those trades was not sufficient to justify taking a trade in those areas. However, when looking at a larger time frame chart as we're looking at here, we are getting between 3 and 4 points out of a counter trend trade, and the same can be said for the strong trend and strong trend reversal trades. So that's why we are looking to manually identify those trades just by the patterns that they create. The next 3 patterns I'd like to look at are the strong trend reversal, the strong trend, and the exhaustion trade. In the strong trend reversal, what we do is we trade from a blue counter trend zone to the opposing blue counter trend zone. And when we do that, we only expect a retracement to minor. So as you can see here, we traded from a blue counter trend zone to the opposite blue counter trend zone. We only retraced to minor right here, and then we formed an exhaustion trade down here. An exhaustion trade is defined as just a reversal from minor. So this is a very common pattern that we can expect to see during our trading, in that if we were given the choice to make a trade based on a larger time frame from either this area or this area, well, in real time we would look at this and we would say, well, we're probably just going to have a short retracement to here, and then we're going to come down and test the low here with an exhaustion pattern. So that is why taking a trade from here in either type of pattern is considered high risk, and this is extremely important. This is one of the 2 patterns that I'm showing you that we are going to consider high risk trade. So when we trade from blue to blue, from here, I would consider this a high risk. The second trade that we're going to consider a high risk is when we form a strong trend. As you can see here, we again traded into a strong trend reversal just by trading blue to blue, but then the market traded even higher and traded up to strong trend resistance right here. At this point up here, if we were given an order flow signal, this is probably an order flow signal that we don't want to take for exactly the same reasons that we wouldn't want to take a trade from down here. I define this as high risk because first off, I don't understand where this is going to stop. It's not always going to stop here at the strong trend resistance. But second, if we only get a retracement to minor as we did here, after the order flow pattern were to develop, we're only looking at about 5 or 6 ticks of profit until we get to the minor support zone. The same thing here, you had even less of a favorable excursion until the market reversed and came down into the extension zone. Now, here's one caveat about the exhaustion trade. This is an exhaustion trade here, and this is an exhaustion trade down here. And what's important to understand is that when we have this reversal from minor right here, when we form the new zone and we're testing the high, that is the beginning of where an exhaustion trade may form. It may trade all the way up to here, which is where the blue counter trend zone is. In an exhaustion trade, we have to be careful if we develop a pattern here that we're aware that the market may trade higher. In reality, at this point right here, we did not develop an order flow pattern, but we did over here, giving us a nice 4-point trade. So in looking at the patterns on these charts, over here we have the strong trend reversal trade. At the bottom, we have the exhaustion trade. There is no trade here because we are in a strong trend, and we would classify anything from here to here as being high risk. We have a strong trend trade and a strong trend reversal trade that both kick off from this minor support. One of the things that makes this a higher risk type of trade, if you're going to make it from either the strong trend trade or the strong trend reversal trade, is that the market can trade all the way to the intermediate support zone, in this case approximately 2.5 points lower, and that trade not be broken. In this case over here, it's only about a point higher that it could trade higher to without the pattern being broken, because we would form a trend trade here and we would form a trend trade here if the market had traded all the way to those intermediate support zones. Now I have gone and put on the ZoneTraderPro indicator itself, which identified a tick divergence and exhaustion pattern over here. And the last bit of information that you need to know that's important about the exhaustion trade is that anytime after either an exhaustion trade or a tick divergence trade, we do not want to take any trend or reversal pattern that may develop. So in this instance, we had a valid tick divergence and exhaustion pattern, and even though we've traded at the blue counter trend zone, that's why we do not see a trend trade pop up right here. However, because we became non-tick divergent down here, which allowed the trend trade to appear right here, this is a trade that we really shouldn't be taking either. This should be defined as a high risk trend trade and should be avoided for exactly the reasons that we see right here. The next pattern that I'd like to look at is called the reversal pattern. So in a reversal pattern, what we're looking at is we have a trend trade, again defined as trading at the blue zone here, trading down to intermediate support here, but the market trades at least 4 ticks through that trend zone. And as you can see here, we traded approximately 5 or 6 ticks through that trend trade here. When we trade through the trend zone, when we return to the intermediate resistance zone here, that's what sets up the reversal pattern for this trade here and this trade here. And the last trading pattern is going to become extremely important, because over the last 2 months I've seen how this pattern has become highly profitable to trade. In this pattern, it's more of a trading technique than an actual pattern itself, because what we're basically doing is we're looking for order flow support at either a test of a high or test of a low. So in this case, we see that we are coming down to test the low that we put in back here. We then trade up for approximately 5 points to a counter trend zone, down for 3 points, and the trend resumes. So you can see there is a ton of money to be made here by identifying this as a test of a low and then taking the appropriate trades, both the counter trend and the trend trade here, provided we have order flow to confirm that. Here's another example of what I would consider a test of a high and basically also a reversal trade, where on the larger time frame we've traded up here at a counter trend zone. We've seen an excellent pullback here of 5 or 6 points, and then we see this retracement here falling about 2 ticks short of the intermediate resistance zone. So this again would be a test of a high and also fulfilling the criteria of a reversal trade itself. What is actually more common to see than the last two examples I gave you is just that we will form an exhaustion trade here at this test of a high. The exhaustion trade again is formed by the pullback here to minor and then testing the high here at 28.69 1/4. You can see that starting from here at the pre-open at 910, we formed a strong trend pattern first by reversing at the minor zone here and then trading to just a couple ticks short of the strong trend zone. That would define a strong trend, and then again we would expect to see just the pullback to minor and the test of the high. The last and probably most important takeaway from this video is identifying where the high risk areas to trade from are on this chart. I've marked them here with circles. To go over it one more time, when we see a strong trend reversal, we are going to see that as a high risk trade down here at the blue zone. We're going to see that it's a high risk trade to trade from here because the market could trade all the way to the intermediate zone and give us a little bit of heat on that trade. This is a high risk trade, blue to blue, and it would again be high risk if we were in a strong trend to trade from up here for two reasons. The first is that the risk reward is not always going to be appropriate, and second, the market could continue much higher than the indicated strong trend resistance zone here. These are probably the most important points of this video. If you have any questions about this or anything else in the video, please feel free to give me a call and we'll go over them. Thank you very much for watching and have a good trading day.